Well, hi traders. I want to talk to you today about global liquidity and system liquidity in the financial markets. I think this is going to be the big talking point, if not the big talking point, as we go past June and into Q3. This isn't just in the US, but it's predominantly a US issue that we really need to focus on. And what this ultimately means, where we see reserve liabilities falling to such an extent that people say, could we see an early end to quantitative tightening? Could we see the resumption of quantitative easing playing through? And what that means for things like the US dollar, for things like gold, for crypto, and for these liquidity beneficiary assets going forward. Now, if we have a look at what we're expecting, this isn't just a US issue. We can go into Europe, where the European banks who borrowed a significant amount of capital and have partly paid some of it back, these are the PEP loans, the cheap loans after the pandemic, effectively will need to repay the remaining balance back to the ECB. We're talking about 500 billion euros of liquidity coming off the European bank's balance sheet. And of course, that liquidity drain could cause some reasonable stress to bank funding rates. And we'll be watching for fragility in European banks. Now, of course, once we get an agreement for the debt ceiling and Treasury Department, who have been constrained from borrowing and are now running very, very low cash balances, will now be given the mandate to go and fund itself and rebuild its cash balances and the Treasury General account. And they will do that very aggressively. Some of the numbers we're hearing are staggering, and that could have big implication for dollar rates and dollar funding and risk assets more broadly. We're hearing numbers between $1.3 to $1.4 trillion of US T-bill or Treasury bill issuance over a 12-month period. And Treasury bills are the vehicle of choice for the Treasury Department to issue. These are short-term debt instruments which have a maturity no more than 12 months. They don't pay a coupon. They have no fixed interest, but they will be issued at a discount and they will redeem at 100, or what we call par. And these are very important instruments within the financial system. Effectively, a lot of institutions will use these for collateral purpose, things like repo, where they'll issue these T-bills, the highest quality assets in the market, and they will get short-term funding in response for that situation, and therefore you can use this for working capital. Very, very important indeed. But they're talking about rebuilding this and issuing this very front-loaded. So we're talking $750 to $800 billion worth of issuance within a 2 to 3 month period. Now, that is a significant amount of paper that the private sector needs to absorb. Now, who are the buyers? Who will be the marginal buyers of this issuance playing through? Now, first of all, we point towards the money market funds, the US money market funds, which have over $4 trillion worth of capital effectively. Now, a lot of this market, this capital has been invested into the Fed's RRP facility, the reverse repo facility. Now, whilst we get technical, the RRP facility helps guides the Fed funds rate, the effective rate. We see that the lower echelons has been guided by the RRP facility, and the upper corridor is set effectively by the interest earned on reserve balances, which is at 5.15%. And what trades in between that is short-term debt instruments, money markets, things like GC repo, T-bills, commercial papers, effectively the cost for very short-term funding from the market. The concern that we have with this is that the money market funds can go to the RRP facility and get 5.05% risk-free. So if T-bills being issued are trading at, say, 4%, 4.5%, and they're trading higher than that at the moment. But once we get an agreement from Congress, effectively yields will fall quite precipitously as that premium comes out of the market. Now, if you can go and get 5.05% risk-free from the RRP facility and yields are trading at 4.5%, well, it's going to be an objective situation where you say these aren't particularly compelling. So yields may have to rise back up to that RRP facility, which could have big implications for dollar funding and dollar rates more broadly, and could see that cost of capital moving up. The second function is those entities such as commercial banks and asset managers that don't have access to the RRP facility, but they do hold reserve liabilities on the Fed's balance sheet. Now, these entities may look to raise cash to take parts and buy these bills by withdrawing and reducing its reserves and liquidating its reserves. Now, at the moment, we see $3.28 trillion worth of reserves held with the Fed's balance sheet and in the system. And if we were to see, say, $500 billion worth of reserves being drawn down, which is the consensus seemingly in the market from rate strategists, then we could see those reserve liabilities sitting around $2.8 trillion. Now, this is really, really important because when we get to a finite point, people look at what we call the lowest confident level of reserves. And that is a certain amount of reserves that need to be in the financial system to give us a cushion against things becoming problematic. You need reserves to a certain level to be ample, otherwise things break and there could be problems. And those numbers is considered to be $2.2 to $2.5 trillion. So if we reduce the level of reserves by $500 billion, so these entities liquidate these positions, so effectively they can take and buy these T-bills, and the Treasury General account effectively is raised, we could be looking at $2.8 trillion, which is not a million miles away from where we are. So we could see some big stress playing through in the financial system. We could see dollar funding rates going up as a result of those low reserves. We could see dollar rates going up, and we could see the US dollar rallying relatively strongly as dollars are sucked out of the system. Now, where this becomes interesting is where we look at the Fed funds effective rate, which is the weighted average of all of these short-term money market rates, such as GC repo, commercial papers, US T-bills, and how it trades within that range. Now, if we were to see the effective rate trading above the top end of the range, the interest earned on reserve balances, then we could see bigger stress in the system. I think this is the indicator you want to look at to show that the market is saying that there's too few reserves in the system. We're starting to see scarcity. If we start trading at a 10 basis point premium of the effective rate relative to interest earned on reserves, I think that's where we start seeing the US dollar rally significantly. I think we get to 20 basis points. That's the level where the Federal Reserve will start to make noises that they may cut back on quantitative tightening. And we may see noises that quantitative easing, at least in the short term, like we saw from the Bank of England, could be coming very, very soon. Of course, a lot of people remember 2019, where we saw the repo blow up and the spike coming through there, where the Fed did an about turn playing through. So we are seeing a situation where there's going to be a significant amount of issuance coming through to the market, where the private sector is going to be asked to do that. We're going to see a reserve liability drawdown playing through, where we could get to a point where we're going to see scarcity playing through. We see the effective rate trade north of the interest earned on reserves. That could have big implications for market liquidity at a time when the ECB balance sheet is falling and banks are being asked to repay that loans as well. So an interesting situation. It's going to happen after the debt ceiling agreement, but I think that's going to be the big thing that we have to contend with. Could we be seeing an argument where quantitative tightening is no longer and the market starts to move on to quantitative easing, which could have big implications for gold and, of course, crypto as well? One to look out for.